Good day, dear students. Continuing with our lectures on various topics in relation to stock exchanges. Today we'll be covering SEBI, the stock exchange itself, and the last topic will be OTC. And um, while discussing OTC, we'll also cover the difference between OTC and trading on a stock exchange. So let's get started. SEBI. So SEBI stands for Securities and Exchange Board of India. It's a statutory regulatory body. Statutory is it is passed by law. It's a regulatory body to regulate the Indian capital markets. So it monitors and regulates securities markets and protects the interests of investors by enforcing certain rules and regulations about how trading has to happen. SEBI was founded in 1992 under the Act, SEBI Act, which was again passed in 1992. It is headquartered in Mumbai, but it has regional offices in New Delhi, Chennai, Kolkata, and Ahmedabad. There are also other local regional offices across prominent cities in India. Now, the main objectives of SEBI include to ensure that the Indian capital market work in a systematic manner. It to provide investors with transparent environment for their investment. So investors know somebody is regulating, so they are more comfortable playing around with their investments. To prevent malpractices in capital market of India and to promote development of the capital markets, and SEBI has been highly successful in that. Now, how is SEBI structured? So just like any other corporate firm, it has a hierarchical structure and consists of various departments, which is headed by different department heads. Some of the departments include foreign portfolio investors and custodians, human resource department, IT department, investment management department, office of international affairs, commodity and derivative market regulation department, National Institute of Securities Market. So apart from the department heads, the senior management of SEBI consists of a board of directors who are appointed as follows. So there is one chairman who is nominated by the Union Government of India, 2 members from the Union Finance Ministry, 1 member from RBI, and 5 members are nominated by the Union Government of India. Okay. So the chairman and 5 other members are nominated by Union Government of India. So what are the main functions of SEBI? The functions are listed in detail in SEBI Act 1992. It basically caters to the needs of the main parties who are involved in trading. One is the companies or the issuers of stocks, the main company, the investors or the traders who trade on a regular basis, and of course the financial intermediaries who facilitate all the happenings in the exchange. Okay. So functions of SEBI would include issuers of the securities. So companies that issue securities are listed on stock exchange. They issue shares to raise funds. SEBI ensures that the issuance of initial public offerings (IPOs) and follow-up public offers (FPOs) can take place in a healthy and transparent way. So we already saw in the IPO process lecture that SEBI completely regulates the IPO process, and the company is required to submit many documents which are scrutinized by SEBI before the company can go public. The next is protection of interest of traders and investors. So SEBI is responsible for safeguarding their interest and ensuring that investors do not become victims of any stock market scam, fraud, or manipulation. So as much as possible, SEBI does try to regulate all this. Then, of course, the third parties include the financial intermediaries. SEBI monitors all activities of financial intermediaries, which include the brokers, the sub-brokers, the non-banking financial companies, and so on. Okay, and it also acts as a mediator between the financial intermediaries and others, and ensures that the trade is smooth. So what are the powers vested with SEBI? So SEBI has quasi-judicial, quasi-executive and quasi-legislative powers. So it is not a court by itself, but it has quasi-judicial powers where it can conduct hearings and pass ruling judgments in cases of unethical and fraudulent trade practices. And this ensures transparency, fairness, accountability, and reliability on the part of all the parties who are involved in trade. One classic example is that of Pearl Agrotech Corporation Limited case, which was as recent as 2015. So SEBI had caught the fraud of this company, which had almost defrauded around 56 million people. And then it also has quasi-legislative powers, wherein it can draft rules and regulations for protection of investors. Okay. And the next is quasi-executive power. So it can execute whatever rules it forms. It can file a case, take action against people who violate the rules and regulation. It can also demand inspection of books of accounts and other documents of any party or any member when they find that something is suspicious. Okay. So this is what we have on SEBI. Moving on, the next topic is stock exchanges. So stock exchange or a securities exchange is a facility where stockbrokers and traders buy and sell securities. These securities include stock issued by listed companies, debentures or bonds, derivatives and other investment products. Stock market is also called the secondary market. So the initial public offering of stocks and bonds to the investors is done in the primary market, and subsequently trading is done in the secondary market. And to be able to trade a security on a certain stock exchange, the company must be listed there. Okay. Stock exchanges may provide facilities for issue and redemption of securities and other instruments, and it also facilitates activities like payment of income, dividends, settlements, and so on. Now, transactions in a stock exchange can be carried out via open outcry system. It's a very traditional system which is carried out probably in a central location such as floor of the exchange, or these days it is more using electronic trading platform. So trade on exchange is restricted to brokers who are members of the exchange. Usually there is a central location even for record keeping, but increasingly all the transactions are less related to physical place, and it is more on online platform. Generally, the prices in a stock exchange are determined by supply and demand, free market forces of supply and demand. So that is how the stock prices are decided. And stock exchanges are part of global securities market. Stock exchanges also serve an economic function in providing liquidity to shareholders, and it provides an efficient platform to dispose of shares and make money. The health of stock exchange or the index of a stock exchange reflects upon the health of the economy on the whole. Okay. So moving on, the next topic is over-the-counter exchange. So there is usually no obligation for stocks to be issued through stock exchange only. So companies are not under any obligation to go through stock exchange, or they are not under obligation to trade securities in the secondary market. So such trading may be done even over the counter. So over the counter or off exchange trading is done directly between two parties without the supervision of an exchange. So obviously it is less regulated. And many times the companies, when they go for initial public offering, if they don't fulfill the prerequisites of a stock exchange, because a stock exchange might have its own terms and conditions, so many times they might just follow SEBI guidelines and might just go off exchange and continue. Even the secondary market trading also continues off the exchange. Generally, trade takes place between two companies or financial institutions in such cases, and this includes all the products like bonds, derivatives, currency, and so on. Mainly these are traded: bonds, derivatives, and currencies. So I have given a small note on the difference between trading over the counter and exchange. So obviously the meaning of OTC is it is a decentralized dealer market. So it is a decentralized dealer market wherein brokers and dealers transact directly and they use computer networks and phone. Exchange is an organized and regulated market wherein trading of stocks take place between buyers and sellers in safe, transparent and systematic manner. So market maker in OTC is a dealer because a lot of things are not regulated in an OTC. Whereas in exchange, it is demand and supply forces which will determine even the prices of stocks. So the exchange itself is a market maker. Generally, OTC is used by small companies very often who don't fulfill the specifications that an exchange requires. And exchange is used by well-established companies. Generally, for OTC, there is no physical location as such. Whereas for exchange, we know we have BSE, NSE and so many other exchanges across India, across the world as well. There is no specific format or trading hour for OTC, whereas there are definite trading hours for operations or trading in an exchange. Generally, the stocks that are traded in OTC are unlisted and stocks that are traded in an exchange are obviously listed stocks. Transparency is very low in OTC. It is comparatively high in an exchange. And one big advantage of OTC is that the contracts can be customized between the parties. Whereas in case of an exchange, since it is regulated by the exchange itself, it is governed by rules and regulations and standards imposed by the exchange. Okay students, thank you so much. From next lecture onwards, we'll start looking at various question papers and we'll start addressing some of those questions. As far as the portion is concerned, I think we are almost done with all the topics. Thank you so much.